Hello. We're going to kick off here in just a moment. We are live with our group, with our community here. We hope everyone is enjoying their Wednesday so far. And when you're listening to this, I hope you're doing well too. Welcome, everyone. In the comments, let us know where you're at. And because we have so much detail, so much value, I do want to make sure we start on time. So we're going to give one more minute. That'll pretty much do it. Hello and welcome, everyone. Thank you for joining me today. I'm Peter Lang. I'm here to unlock growth with programmatic M&A. Now, besides running multiple holding companies and investing and owning agencies, I have the privilege of teaching agency owners, service professionals, how to buy other businesses, basically buy their competitors, scale, and grow to achieve the financial freedom they've always wanted. Now, here's the gist. I'm not just going to share M&A strategies on how other programmatic buyers like us go out and compress time and hack growth in our businesses by acquiring. I'm also going to show you how we did it for Growth Hackers. As one of the partners of Growth Hackers, we acquired the business a little over a year ago and have been working to release some exciting new initiatives. This business itself is the personification of the tactic we are teaching you today. Joining me on my team is Corey and Laura. You'll see them in various places on the lives or in the comments. And we're here to, provide value. I'm looking forward to connecting with everyone, hopefully via LinkedIn. If you do send me a LinkedIn connection request, note Growth Hackers so I know and my team can accept you. And of course, any questions that come up, the team will field, and hopefully we can get you your answers. Now, why listen? You might be wondering, with a sea of information out there, why should this session be any different? Why should you invest the next hour with me? Now, the answer is simple yet profound. This is not just about gaining knowledge. It's about transforming that knowledge into tangible growth. If you're on this training, chances are you're an agency owner who wants to complete their first acquisition. You want to scale. You want to grow your client base, your team, your service offering, but you're unsure how to get your first acquisition funded, or maybe how to find even a company to acquire. Or maybe you're a marketing professional working in a company and you want to go and acquire an agency instead of going off and starting one from scratch. Well, this is the perfect training for you. And by the end of this training, you'll see how you can find, source, and learn why your first acquisition is where you should be spending your time, even if you don't have access to cash or credit available. So my promise, if you don't want to lose money on failed attempts to hack growth through your first acquisition, if you want to avoid making mistakes that could cost you hundreds of thousands of dollars, millions potentially, and you want to understand this black box of M&A, stop everything else you're doing and focus on this training for the next 40 minutes. And make sure to stay at the end so I can send you an exclusive invitation for some optional additional training that I'm hosting. Now, this is something I provide my agency M&A masterclass alumni, And it is the breakdown of the step-by-step process of how we source, evaluate, fund, and close deals worth millions of dollars of contribution to your business. Now, why should you listen to me specifically? Well, I've been in the agency business for over 15 years. I've built agencies from scratch. We'll never do that again. And understand the struggle that it takes to build something from nothing. I know the growth marathon, the day-to-day hassles and joys, long hours, uncertainty, feeling stressed, and feeling grateful too. The years it takes, to cross 1 million. There's nothing fruitful about having an agency startup. Starting from nothing is hard. It takes time, and most fail. And again, stay to the end for a special invitation. Now, I've acquired agencies, I've rolled them into platforms, which is a entity that is the first business that we tuck things into. I've kept them as standalone independent businesses, and I've completely changed their religion and integrated them. I've spoken to over 3,000 agency owners since 2019 on what they want and how they want to get what they want from programmatic M&A. I'm also the founder of a boutique private equity firm. We've been buying and investing in agencies, and I've trained hundreds of agency owners and entrepreneurs how to grow through M&A, through my agency M&A masterclass. And I said as a board advisor to 4 active roll-ups, former students of mine who are using M&A to unlock and hack growth. But first and foremost, I've been where you are. I know you wear too many hats and, like me, struggle to find people to share the load. And I know you all want to grow and scale. You want more prospects, more sales. You might even create something new, reinvent the wheel to make that happen, and build new systems and new sales strategies to support it. Conferences, trainings like this, classes. You've been to so many, you probably have earned 3 MBAs. You want to get to 5 million in revenue, 10 million, 20, and you've all got a plan to get there in 5 years, maybe 10 years, 20. Well, at least by the time you retire, if you get to retire. Slow, organic, maybe a fast forward button. A way to get your 5-year plan faster than you imagined possible. Maybe an easy way to solve your growth problems. To transition from running in circles, reinventing the wheel, to being part of rapid growth. To scale, unlock liquidity, and maintain control over your growth. Maybe, just maybe, the answer to all your growth problems is mergers and acquisitions. Maybe that's your key to success. I did an acquisition in 7 days. With that one deal, I added a year's worth of revenue. It also had a 25 plus year old domain with reputation, reputable backlinks, and domain authority. Now, we had consistent annual growth, 20%, but almost overnight, we doubled in size. With that one deal, we had twice the clients, double the revenue, and an extra 200K in the bank. Not bad for 1 week of work. Now, it was a fairly small deal relative to what we do now, and it shaved years of work trying to scale to that level. And after that deal, I thought, why the hell am I spending time doing sales and marketing? How much time have I wasted entertaining the tiny, incremental, organic, slow growth? I could find another agency that had 30% of our size, 50% our size, and acquire them. Because you can solve every business problem and surpass every growth goal with mergers and acquisitions. It's my superpower and it can be yours. M&A is a fast forward button to your growth and exit. And wait, I don't have to hire more people to increase our capacity or build a more diverse workforce. I can find another business that has the right team and acquire them. Then hang on, I don't have to go to conferences, sessions like this, read all the books and learn everything about businesses and growth. I can find a company that's already doing it and acquire them. I don't have to expand my offerings to meet demand. I can find another business that already offers complementary services and acquire them. Wait, I don't need to spend years establishing an esteemed reputation in an industry I want to break into. I can find another business that already has that reputation and acquire them. In that moment, I made a life-changing decision. I'm no longer doing anything other than M&A. That's how you grow a company. Not by grinding it out to reach some 5-year goal, which we all know really takes 15 years. Not by trying to learn everything you can about every aspect of business. Not by taking 2 steps forward and 1 step back. No. You can solve every business problem and surpass every growth goal with mergers and acquisitions. M&A is a fast forward button to growth and exit. To 5 million, to 10 million, 20 million, double in size, then do it again. Then do it again and again. Every deal increases a business's value in multiples. This is how you eventually sell your business for a lot more money than it's worth today. For a lot more money than you imagined possible. Here's a purely financial illustration of why programmatic buyers do this. The companies that we as buyers are looking to buy are smaller. Right? Let's use you as an example. Maybe you're running a small business and making about $400,000 in profit a year. On the market, that could trade for about 2 times that earnings. That business could be valued $800,000. But when I show up with my 10 million of EBITDA that I can trade for 8 times my 80 million enterprise value, and I acquire your contribution, your profits, your 400,000 in profits get my multiple. I turned $800,000 in value to 3.2 million by buying it. That's the arbitrage. Now, to do that, you need a predictable and repeatable process. So I'm going to give you a 5-step process to follow. And I'll walk it through as a story because I think it's easier to understand. So in 2014, I owned an agency and I was the primary salesperson. Maybe we can all relate. Now, I had this view that most owners have. No one can sell my services as good as I can. Or at least I couldn't hire anyone to do it better than me. And that's the dilemma of being an owner-operator, right? You think you have the most experience and you're the best person to represent the company. At that time, I wanted to go on a sabbatical, step back from our businesses, and then come back and purely focus on M&A. So I did what everyone tells me to do. I hired a VP of sales, a gentleman, Jack Carroll, close to 70. He helped create the documented sales process, and we hired 2 more salespeople because you can't have one. You got to hire 2 for it to be competitive to work underneath them. Now, they did okay, but when I came back after an 8-month sabbatical, I realized the company hadn't grown at a rate it should have. The rate it would have had I been doing sales. I had failed to meet my goals by hiring someone to replace me. This is where so many owner-operators, we all jump back in and do the work ourselves, or end up on some fruitless trial and error search for the right hire. This is the problem I realized I could solve with M&A. So, phase 1, find. We have to find potential companies to merge or acquire with. To solve my problem, I needed to find a company that we could transact with with an owner who sold well and who liked selling, because owners do make good salespeople, but who didn't want to run a business. So I was introduced to an agency that had two partners, Tony and Tommy. Now, Tommy handled sales. Tony ran the company, did the services. Now, this company seemed like a good prospect, so we moved to the next phase. Evaluate. This is where kind of does what it said on the tin. We evaluate the company that we want to merge with or acquire to determine if they could help us reach our goals. They help us solve a problem we have. Now, when I was evaluating Tommy and Tony's business, I learned that they're 50-50 partners. When they formed the company, they agreed on equal salaries. Fair. This was a light bulb moment for me. Salespeople aren't incentivized by having a fixed salary. So Tommy's selling, but he's not compensated or shows any benefit when he closes deals. There's a compensation gap there. And he felt, under market for his contribution. And when I asked him, how many hats are you wearing? 5. And he kept getting pulled back into the business to help manage expectations with deals he had already closed, to help serve clients, although that's not what he was responsible for. And it slowed him down. And I asked him, what if the only hat you wore was sales? Because I can make it rain. And here's how, and he broke it down. So when evaluating the business's performance, I looked at historicals. But it really wasn't indicative of where the company could go, right? I was going to double down on his potential to sell. I determined we found a good prospect, an acquisition target, and move forward in the process. Phase 3, structure. This is when you structure terms. Ultimately, when you buy a company, the owners want to know if you're going to compensate them in a way that helps them take care of their families, the things that they personally want to do. And also, they really care about what it looks like after the deal in most cases. What will happen to their team? Are they in good hands? Now, when I constructed Tommy and Tony's deal, I made it very clear that within a short amount of time, all Tommy would do is sell. And I promised to compensate him a higher base than he was making today and with much greater incentives on what he could contribute moving forward. And for Tony, the deal's all upside. It's a win-win for both because they had friction. This back and forth between sales and service that so many small business founders, accidental entrepreneurs find themselves faced with after 4, 5, 6 years of running their own business. Right? If you can solely focus on the thing that you're best at and it helps generate the type of income you want, it's life-changing. Now you're ready to close. Phase 4. This is where you create all the agreements. You need to actually formalize and finalize the deal. This is all that legal stuff. This is where a deal can be made or a deal can die. So don't just toss contracts and agreements over and hope the other party agrees. Sit down with them and walk them through the deal and explain why it's constructed the way it's constructed. Don't have your attorney just talk to theirs. And that's what I did with Tommy and Tony. Purchase agreement walkthrough, I call it. And with that, they feel like they're a part of the process. It's collaborative. It's not a negotiation. And at the end, they thanked us for our transparency, our communication, and the level of disclosure and education we wrapped into the process. Right? They felt like they were a part of it. And that's what makes a lot of the difference. Now, this process can seem overwhelming. And so when we break it down, you can usually get to the close. Doing deals is easy. Closing deals is quite straightforward once you've gotten a few under your belt. But the real challenge comes when you integrate. So it's our final stage, phase 5. This is the phase where you bring the companies together. This is where I like to say our differentiator is in the marketplace. We don't just teach people how to do deals or how to source motivated sellers. We teach you how to create value through smooth and confident integration. This process can take a few months or longer, but it's easier if you've done your due diligence in advance. Now, it took 6 months to get Tommy and Tony fully integrated into the company and him leading sales, but man, he outperformed all previous salespeople, and he outperformed my historical contributions in sales. Problem solved. If this M&A process feels overwhelming to you, that's normal. People don't teach this in entrepreneurship. They don't really push the grind of M&A or doing deals. They push entrepreneurial, startup, innovation. Because like when you started your business or you started doing your profession, M&A wasn't something you were exposed to. You're just thinking, how do I get more clients? How do I position myself in our industry? How do I set up systems so I don't have to do all the tasks within the department or the job or the business? You didn't know how to do any of those things, though, and you learned. Now it's time to learn M&A. You can move into this step because it's a learnable process. And it's not rocket science. Sure, you need to know and do a few deals. Yes, you should learn each step. It's a process, but it has a logical sequence. Now, if you're on this, I do have part of my newsletter. I will train you for 21 days. So it's a free offer. It's to join me. All of you are marketers. All of you are savvy enough to know this is about joining the list of people who will hear about my book when it comes out. So my reward and my gift to you is 21 days of M&A training. Sign up, join my newsletter. I'd love to see you on it. The emails come directly from me. When you reply, they come to me as well. And it will teach you this M&A process. So you can do it over and over and over again. And once you have a few deals under your belt, the whole world opens up to you. If you thought marketing, growth hacking was a skill that you thought you needed to learn to be sustainable within your career, M&A is the next level for you. It's actual natural progression for those who are marketing and sales oriented. So I'm going to give you some rules. Buying acquisitions. These are the 3 first deal rules, because many of you have probably not done deals yet, but you will want to do deals. Now, the objective is to enhance the probability of successful acquisitions. I want you to maintain organizational cultural integrity, and I want you to realize the intended deal thesis, the reason why you're doing M&A, why you're trying to transact with another business. So the rule, when considering acquisition targets, the company should be limited in size to 30% your employee count. Not rocket science, pretty simple. If you're 10 people in your small agency team, should look at an acqui-hire group of 3 people potentially, or a small transaction of 3 to 4 people. Right, this threshold is designed to facilitate smoother cultural integration and operational assimilation. Same thing goes for 100 team members. If you have 100 employees, 100 team members, and the first acquisition you do has 30 people in it, that's easier to assimilate into the system versus 50, 60, 70, 80, 90, or 100. Yeah, I get it. Big moves matter, but so do these small ones. Now, McKinsey highlighted in their research that big moves for strategic growth are key, but it's really those smaller acquisitions that bring the most impressive returns. And the rationale is quite simple. Value creation doesn't happen from a deal, it happens from integration. And having a manageable integration size through smaller acquisitions, right, by keeping that employee count smaller, means it's going to be easier to integrate, easier for you to unlock value. Cultural alignment is going to be easier because even if there's not a perfect fit, it's small enough of a bite to where you can train them and integrate them and onboard them to your culture. Operational efficiency. These smaller acquisitions reduces the complexities of merging operations. They're maybe not as rigid because they hadn't built up as many standard operating procedures to supply the value that they create. And also helps minimize employee disenchantment. Right? Smaller teams now get to be a part of something bigger. Next rule. Avoid projecting personal biases on sellers. This is important. The way you interact with the world is not the way everyone else always interacts with the world. So understanding a seller's motivation, a reason why someone would sell you their business, and recognize that the motivations behind their decision to sell, especially in small strategic acquisitions, are often deeply personal and varied. These motivations may include in retirement, desire for a lifestyle change, health issues, an expanding family, a shift in personal interests. So coming to be aware that this diverse seller perspective is a reality, and it informs deal structures, and often deal structures that may be ones that you wouldn't accept if you were in their size or their stage of business. And from some examples would be things like seller finance, deferred payments. And sometimes things are more incentivizing for tax implications versus, some big economic windfall. So it's important that we respect sellers' choices and acknowledge that they might seem unappealing to you, but they could be perfectly aligned with what the seller's personal goals are and their financial planning. Next rule, 5. 5 deals for you not to suck. Hopefully that relieves some of the pressure. Completing 5 small deals is essential to developing an M&A skill. You don't do meaningful things once and think you're going to get good at it. And knowing that it takes 5 hopefully reduces the pressure and stress associated with your initial acquisitions. And kind of the explanation behind this is called the gradual learning curve. Right? Starting with smaller deals allows you to gentler learn the things around M&A. It reduces the high stakes pressure, the intensity often associated with larger, more complex acquisitions. Stress management, right? Engaging in smaller deals, multiple deals, helps you kind of distribute the pressure of those value creation opportunities across a lot of activity. Prevents you from getting overwhelmed that you're trying to swing for the fences the first try. And it builds resilience. With each deal, an acquirer becomes more resilient to the changes and uncertainty that is inherent in M&A. And ultimately, you gain perspective. The more you do, the broader perspective you can bring to your own business and what successful acquisitions look like for you. Last rule. You can acquire much more than simply businesses. This is a great example. When we acquired Growth Hackers came with a huge community of growth hackers. We were one of them in the early days as well. Events, online community, newsletter, podcast, Slack channels, domains, YouTube, podcast channels, anything actually that you can think of is available to be acquired to expand how you approach the market, how you get in front of your target audience, how you educate them or persuade them to buy. That's why it's the number one fastest way to hack growth. Why spend years on an SEO strategy when you can go acquire domains that have more domain authority within the category of your industry with your target audience in a single transaction than your investment in marketing? Now, I say this, it's blasphemy. I was an agency owner. I was selling these types of services. But when I found that out and I saw and I did it, I knew it was the thing that we need to empower the community to do and leverage. Because at the end of the day, you can acquire market share. Your competitors who look just like you or are slightly smaller than you, even bigger than you. You can acquire media to get leads, reoccurring revenue that then you could leverage to get additional capital. We talk about building standard operating procedures to level up departments and businesses. Well, other businesses already have those standard operating procedures figured out. You could go acquire them and then deploy it across your business. IP for innovation. People already doing AI agents and already doing the things that enhance and enrich service delivery teams. You don't have to reinvent the wheel and figure those things out. You can add additional products or productize your services who's someone else has already proven. You can add service offerings and expand your locations and regions. You can increase lifetime client value or customer value by bolting on different things across the life cycle stages that create value for them over time. And then you can also acquire anything in your OpEx to have better margins for your production or distributions, or the way you supply or create value. Every direction you can transact. If you've ever seen an agency or a business grow and they added a new office, they didn't go send somebody to go live in Houston to open an office. That's an acqui-hire deal. That was a small book of business by 1 to 3, 4, 5 people who, instead of being independent, bolted onto something bigger so they could go to market stronger. New verticals, new products. I acquired a highly engaged agency mastermind community group. 70 digital agencies have been together since 2011. Instant audience, recurring revenue, educational value I could provide to them day one. Proven success versus trying to start a community on my own. Speed to market, already in progress, already engaged. Leveraging relationships versus starting from scratch. At this stage, solving business challenges through acquisitions isn't just a strategy, it is the strategy. And from my research, the reason why most don't get into it, it boils down to 3 reasons. They feel too risky. They lack scale, so they can't implement it, or they aren't highly liquid at all. And that's why most small businesses, because if you're listening to this, you're probably one of those. This is why you're ignored by the global investment community. That's why it's not easy to get a loan or get debt. This is why big private equity firms aren't knocking on your door to buy you. There's more of these small ones. But this means there's more opportunity for you. More opportunities for you to hack growth. More opportunities to solve your business problems with mergers and acquisitions. Now, what should your first deal look like? Well, I want you to focus. In order to focus, you need to understand that there's some basic parameters at every size. You hear a lot about Main Street or small businesses. In the US, the Small Business Administration classifies a small business as less than 500 employees. I don't know about you, but if you got 300 employees, it feels pretty big. And if you got 30 to 50 employees, getting up to 400, 500 seems challenging. So realize it's a big, small category. In the US, and this goes for most developing nations, 50% of the US GDP is made up of small businesses. So just by pure number and unit economics, it's a big category. So typically they trade for lower values, and we trade on the earnings we can create. So if you hear revenue multiples, that's unrealistic for small businesses. Most things are, if I'm going to deploy cash to buy something, I want to know how I get a return on that investment. And so small businesses, because they generate typically less cash, less profits, their return profiles are more compressed, and there's higher risk because they're small. And so they trade for lower multiples on those earnings. So between 2 to 5 times. Now there's this next classification up. And this is where you hear private equity. Private equity is a rebrand of leverage buyout, which is essentially we are going to put debt on a business and then impose ourselves. Now, these are bigger businesses, and they typically trade for higher values. And then the next group of that is capital markets. These are businesses that trade for much greater than small businesses or even middle market businesses. So these are publicly traded businesses. But there's an arbitrage with each one, like I was illustrating previously. When a publicly traded company buys a small one, that profit contribution is at the trading value. the gain that they get. That's why it's so important to understand how to quantify a multiple return for the buyer. If you're selling the business, or if you're a buyer, know how to give a seller what they want in a way that you can measure the return. Now, there's 4 primary sources of funding transactions. So you have our assets, you have the things that are tangible, and you can get a loan. There's lenders that do asset-based lending or receivable-based lending for service companies. This is where you use the existing assets. These things are on the balance sheet or the accounts receivable to get an acceleration on that to fund a portion of a deal. And you get to use the company you're acquiring's financials backed by yours if you're a business going out and buying to get that loan. There's equity, so you could trade in consideration, so your own equity. So if I were to go out and buy a company and give as consideration 5% of my company as a form of payment for that, you can. Equity also comes in the form of investors, outside people who can come in and put some cash in the deal, and they take equity position because you're giving the cash to the seller. And loans. The U.S. has a wonderful program. The Small Business Administration has the 7A program, which is the SBA loans you hear so much about. And these are typically leverage buyouts, so debt on the business, but amortized over 10 years. So a lot safer. And the parameters of that loan go from, $1 million plus to 5, and there's ways to tack on. Great program if you're in the U.S. or U.S. citizen. Great program if you're a business looking to expand by buying another company. And there's many, many other sources. And there's ways to come up with a structure, but I'll walk you through a basic example. A small business, say it's selling for $600,000. This is what people don't often realize is you can actually put money in your pocket as you're transacting. And so you go and get a loan on the business and you need enough to make a down payment. And so you're factoring future payments. You're going to make $100K as a down payment to the seller. You go and do AR financing, so accounts receivable financing. Let's say you unlock $150,000. Well, you gave $100,000 of that to the seller, and $50,000 is yours. So what people don't realize is in small arbitrage, people are putting money in their pockets every transaction. It's like a dividend recap. Essentially, the business takes on a little bit of the loan, so you can distribute the proceeds to you as the owner, or you as the initiator of the transaction. So not only are you growing your business, growing its revenue, growing its profits, you also are extracting value and putting it in your pocket every time, and potentially every time you do a deal. Now, fundamentals. If you're in the service industry, agency world, there's 2 powerful funding mechanisms that are the key components of this. Now, we love seller financing, especially in the agency industry. The seller holds the note. What that means is instead of going to a bank like a mortgage and getting a bunch of money and then the bank or institution carries the note and you have covenants, you have requirements that you have to meet, the business owner carries the paper. Therefore, there's a lot more flexibility there. Now, you may be thinking, well, hey, Peter, that's wishful thinking. It's pretty uncommon in things like real estate and other areas to do this, but not so in business acquisitions. For the frustrated founder of a small business or someone who's burnt out, who's been doing it for a long time, whose net worth is tied up into this company, getting a gradual payment is sometimes the closest thing they can even expect from selling their business. And a steady payout of income. It's very similar to annuity. The owner may keep some equity, may have some recourse to take back the asset if it's not paid, if those amounts aren't given to them. And there's all these things that could potentially decrease the purchase price. We can defer payments to them on agreed upon benchmarks to make sure that, if you sold the business in January of 2020, but then you got hit by COVID, the business suffered. Well, if the business can't meet its own obligations to pay you, you might be more flexible to help it do that versus a bank that has a lot of restrictions on its ability to be supportive to the nuances of the business. That's where the balancing of the scale really happens. And then there's earnouts. Earnouts are where individuals are getting paid based upon their ability to perform, or the business's ability to perform, to the representations of future performance, the metrics that they're so enthusiastic about, the things that they believe in the business. So just realize there's reasons why seller financing is very advantageous. And it can unlock things with the business. It also gives it a lot of flexibility. It's also very, very common to be a material component of most deals, especially for ones that are smaller, especially ones that would be classified as riskier opportunities. And yeah, they have some instruments on them like interest. They can be treated very similar to how you would do a bank loan or get a financing, outside financing lender. And again, there's liens that could be put on. There's first positions. There's ways to protect the seller and put in place recourse if underperformance is on the buyer side. And again, the worst thing happens, they get the business back. Now, you may hear people, well, if I sold, I don't want it back. That's telling too. And the earnouts. Well, the earnout, the contingency payments. Well, sometimes these are very incentivizing. When there's a valuation gap, so I feel the future value of my business is going to be worth more than the present value, or the past represents, I can get a piece of that future growth and be rewarded for that happening. That helps mitigate the uncertainty of that happening for the buyer, and it helps give me more as the seller. And it should always be based on performance. It should be off of collaboration on creating a positive impact. You don't want to sell a business right when it starts to plateau. You typically want to sell the future advancement and growth that's still available to it very transparently, very clearly to the next owner. It's got a lot of ways that you can measure that, from revenues to EBITDA, free cash flow. It can also be tied to gross profit if you're concerned about the way the business could be managed moving forward. But if you're concerned about that, consider who you're selling to, and there's ways to recourse that. It could be tied to events. So say, 60% of reoccurring revenue is with one or two accounts. And you're like, well, those are about to renew. Well, then let's tie the performance of the payout to those renewals to ensure that I don't pay you a bunch of money, those clients quit 6 months later after I bought it, and I have a material adverse effect that makes this deal something that I didn't expect. It could be on retention of team, right? If you have key people that run the business and they need to stick around, if they leave, the value of the business you bought is gone. That's concerning. So these things are built in to balance the scale, to make sure there's a fair approach to the future expectations on a business. When you buy a business, it's present value for future expectations. We don't buy the past. The past already went in your pocket. We're buying what the business is going to create for us in the future. And we need your help as a seller to make sure that happens. Now, I have some quick examples that I'll give. But if at all this is resonating, again, reach out to me on LinkedIn. Sign up to my weekly newsletter. We host agency podcasts where we talk about agency acquisitions and exits of my community of people who have bought, sold, share their stories, give you best practices, teach you what it is we do, and really feed into this opportunity that we believe in. I'm going to pontificate on this really important example and really critical for our industry and for the economy as a whole. We are in a period of time where the vast majority of assets, whether it be real estate or businesses, are owned by baby boomers, by individuals who are aging out of the professional career portion of their life. Those businesses need to transition. So they need to either transition to the teams because their children aren't taking these on, or they need to be purchased by other parties. Well, if we have 50% of the US GDP, small businesses that are a significant amount about transition, you learning how to go buy the value creation systems that already exist and enrich them is probably one of the most pinnacle opportunities in our history. We have to sustain that value to be competitive globally. This is a learnable skill, just like everything else you've done. If you're learning to be a better manager, learning to be a better leader, learning to do sales, learning which AI tool is going to unlock efficiencies for you. All those things are learnable. Same thing with M&A. You just have to be in the room where this is the common language being used, right? Learning Italian is easy if you're immersed in it. Learning Italian when you're not immersed in it is much, much harder. Now, some small examples, just to make sure we see how these will come together tangibly. A small strategic acquisition. This was the development team, which this was the transaction back in 2020. Small percent of profit. The multiple on that was about 1.5. Now, how we were structuring that, this is called an acqui-hire deal. And in an upcoming podcast episode, I share a story of Scott Allison and how he grew Allison and Partners using this exact model. And I did the same, which is we're going to give you a percentage, a commission off the book of the business that's coming in, and you get that in perpetuity. Then any new business that comes from the brand that we left standing that's bringing in opportunities, you'll get a cut from it. Even though we're delivering the value, we're closing it and we're supplying it. And this became, a way for those founders to make almost twice as much in earnings than they did running their own shop, which depending on where you are in your stage of life, if you have young kids or you're about to have young kids or you're just getting married, these things could be really good step up in household income earnings for you to reinvest in other things that are material. Another small strategic acquisition. This was a little under $1 million in revenue. Profit. Again, profit is the term I like to use. EBITDA, if I quote Charlie Munger, is bullshit. There's adjusted EBITDA, adjusted earnings, seller discretionary earnings, all these things that kind of jerry-rig the business. I like to say, within the relative operations of the business, how much cash flow does it throw off? Yes, I understand small businesses have owners that push things through it, but let's get to the profit number as best we can. And then, if those one-time expenses we adjust out, fine. So this was, again, very simple deal. Again, less than 3 times multiple. So 2.78 is where the economics landed. And this ended up being, $325,000 for this business. And it was structured under a guaranteed payment format, kind of that annuity description that I was referring to. Again, consistent payments over a certain period of time that got this consideration paid out. That was appropriate, that worked for the seller, and there was other ways that he was compensated and incentivized. Another one, again, I'm doing these in step-ups in revenues. This was a media buying company. EBITDA closer, good, healthy media, but this was mainly because it was a percentage of ad spend being managed by the firm. Now, as you get a little bit closer to that million in profit, million of EBITDA number, the multiple is going to go up. So this landed about 3.3 times because it was really that enterprise value number we were really trying to land. And this was 2.7 million. And this was a owner who had been in the business 30 years and was ready to retire and wanted to be retired by a certain age. So the timing of this really worked well. So we had some cash on close built into this, ended up being about 10% cash on close. We had guaranteed payments structured as an earnout, meaning once the money was received, it would unlock the payments because there was some uncertainty with some of the contracts. And then because she was still motivated and wanted to motivate her team, there was a preferred equity instrument, meaning there was ways for her to get more value unlocked in the future as we continued to invest in the team, as succession worked, and the business continued to thrive. Anyone who wants to be out by a certain date, it's like a countdown. The business starts to underperform quite a bit as that countdown continues to get closer to zero. This is kind of how it looked like in regards to like basic structure. So we had kind of the first payment. That was that cash on close consideration. We had the amortization of their payments for the earnout listed here. Shows you what the monthly payment was. And there was still a consulting fee, essentially like the salary for still being in the role for the transition period. And then that preferred equity instrument, big word, just meant in the future, we would revalue the business and it can either be converted into payments or it can convert into equity and they could participate when we sell that business in the future. Again, this is more creative structures. You don't start with these, obviously. This is what you get to as you start to learn and immerse yourself in doing deals. Now, platform. I talk about platforms. A platform agency is typically, or an anchor agency is the first deal you do, and then you're going to add on, bolt on, tuck in, those are all the words for it, other businesses to make it bigger. And so this was a $6 million in revenue, $3 million of EBITDA business, acquired in 2022. Coincidentally, same year my daughter was born, very active year. This is a non-flinch 5 times. So when you get to 3 million of EBITDA, 5 times on that is pretty market. It can go a little higher, it can go a little lower. There's things that influence it, but really 5 times for 3 million, it's such a pinnacle threshold that this is what you should expect in market. I will say, private equity, they look at this size business, but not as a platform. Just to give some context, private equity looks at platforms at about 5 million of EBITDA. There are a few that have gone a little bit lower now recently, but that's usually the starting point that we see most private equity participate in. Also goes up as a first business in a category, and then their strategy is to do programmatic M&A, exactly what we're covering today, and adding on revenue and EBITDA and scale. Now, we structured this as 100% buyout. 60% of the consideration was taken into account because ultimately we wanted to give some ownership back to the team, which is also very important. This owner had 100% ownership, and it caused some of the friction with the management team that was running the business. This owner was out. He was like chairman of the board of his business. And so we structured the payments in this format. We did a deferred down payment because there was some disgruntledness between the CEO and the chairman that we wanted to mitigate some uncertainty. So we tied the performance expectation and we closed, and then we would make our payment. And then we deferred another component part of it because we had a big contract renewal coming up. So we said, all right, 12 months after the close, the next one can happen, and then following up. We also incentivized management team. So there was a portion of the consideration that was carried over to the management team as payout. Again, very key. The people who run the business are not always the people who own the business, and they need to be incentivized to continue to do that for the new owner. And that was how we approached it. Now, if you haven't signed up to get it, do sign up to get my 21-day email course. I'll drop it again in here. It was really important that everyone have this as an option. We also have Corey Rich here. And if you're interested in what M&A could look like for you, reach out to Corey and Laura. They'll get you scheduled and talk through how M&A is available to all businesses, how you don't have to start from scratch. You can do it. I call this my gray hair Gandalf stage of my career. Although I still have my portfolio company, I still have growth hackers. I still have our communities. I'm very much in a position where if we can empower you to implement these strategies, it's going to be transformational for your career. AI is not going to take your job if you're doing private equity activities. If you learn how to go buy businesses instead of start them, no one can dethrone you. If you can go and expand your current business or a business that you can participate with in the future through M&A, you become untouchable. Nothing else will hack growth faster than M&A. So reach out to us, connect with me on LinkedIn, make sure to say growth hackers in it. And although I'd love to answer some questions, I am having issues seeing any questions at the moment. So let's connect. My LinkedIn's here. Again, when you send that connection request, make sure to mention that this growth hacker session you joined so we can accept it. And then sign up for the 21-day. We do have agency M&A training available to you. Essentially everything from sourcing a deal to integrating it. I spend 3 to 4 sessions focusing on integrations. Nobody touches integrations the way we do. No one, I don't think, cares as much. Everyone talks about buying businesses, doing transactions, the economics around it. That's how they incentivize you. That's the seductive, sexy thing. The real value creation is unlocked in integrations, unlocked in empowering leaders. And that's why we spend so much time talking about how we've done it. Over 20 transactions. I'm fortunate to have mentees and students who implement these strategies and prove that the people you don't think could do it, do it. So again, connect with me on LinkedIn, reference Growth Hackers. Let me know if this was valuable to you, if you are going to make that life-changing decisions like I did. M&A can solve all business problems. I appreciate you. Thank you. I'll see you on the next one.